All right, cool. Welcome to Be the Market Expert. And let's kick this thing off with some vision speech slides. And so, what's cool about Family Reunion and Gary Keller every year is that they throw through KW research and with Ruben, who's our economist, and they go through and they just look at a lot of data. And what's neat is obviously we're pulling from NAR, we're pulling from Altos data, we're pulling from a lot of different sources. But also, what's neat about our company, just so that everyone's aware, is that we actually share data between all the different franchises. And so, like, Elizabeth, for 2 days out of the month, actually compiles all of our information and sends it all out to KWRI. And just every one of us shares our data. So, what we get to do is we actually get to see all the different trends that are happening in our individual areas, which means that we have, the largest database of real estate agents and like what is truly happening. So that's why, when I see these searches and these surveys that come through, especially like that 78% of all real estate agents didn't do one transaction in 2024. And then like you look at and you're like, surveyed, 500 people, and you're like, how accurate is this data? But anyways, here's one that I do like, and I love this one every year when this one slide comes out. And this is your home prices annual appreciation. And so if we were to look at this thing and we're just looking at this green line, this is the long-term trend. So historically speaking, since 1990, we have seen a 4% increase in appreciation year over year, which I think is very important, especially as we're having conversations with our clients and we're being that real estate economist of choice. When we're going through, we're having these conversations, the more conversations you have, you'll actually sit down with people and they're going to say, you know what? Prices are too expensive. Interest rates are too high. And they say, you know what we're going to do is we're going to hold off on purchasing a home until next year or until something happens. If we were to look at this thing, we know that we're seeing 4% appreciation year over year over year. So then we're going through and we can do the math, right? We can say, you know what? Hey, this home price next year is going to increase 4%. So literally, you're getting outpriced by the same home that you can afford today. You might actually not be able to afford it next year, which is very interesting, especially when we're started looking at just wage growth in the United States. And so when we're talking about wage growth compared to home appreciation, and if you can afford a home today, that does not necessarily mean that you can actually afford a home next year. And so here we are, we're actually living, and where we are right now, we're actually 9.9% above the trend line. And while it's not going up as much as we were seeing, because especially in Colorado, it's going gangbusters, but we are still way higher in appreciation. So when we're looking at this thing, I saw a piece from I think it was the Wall Street Journal today, and it was like, which one's better, cryptocurrency or real estate? And they were actually trying to draw a correlation to cryptocurrency being a better investment than real estate. And what was interesting is they even had a photo of like a car being crashed into a house, and they were saying, well, this doesn't these are physical assets. And then they were trying to draw a correlation, so like living in California or Florida, and like that's where they were actually leaning this information on, because all the natural disasters that they have. It's very interesting. But when we're looking at this thing, here's the appreciation. This is the talking point. Since 1990, historically speaking, homes have appreciated 4% year over year. And right now we're sitting a little bit above that. We're sitting at 9.9%. But let's look at this in this next slide. So here's your home prices, here's your annual appreciation, and actually breaks it down. So we can actually see from 2006 to 2011, it was not that great, right? We can actually see during that time span, it averaged out to about, 4% negative year over year. But if we're looking at this thing, here we are at 2.7 from 23 to 24. A lot of that is being driven by interest rates, right? We had fewer homes hit the market. And on top of fewer homes hitting the market, interest rates stayed very elevated. So as we're going through and we're looking at these different things, they're projecting about 2.5% this year, which still puts us well over the trend line, right? Like if we're going through, yes, we're not going to hit 4%, but yet the trend line isn't going to be moved too much. So we're just looking at this thing, and even if we were at 3%, right? Like whatever number you want to use, 4% is the real number. But let's just say that someone wants to go, well, do you really think that homes are going to appreciate that much, even at 2%? Right? If we're looking at a 2% appreciation on $600,000 home, and if they're not envisioning that, interest rates are going down, because here's the conversation for anyone that was on yesterday's call with the region, right? We brought on an agent and they gave the market update, and what they said was actually very, very real. So if we're looking at these things, let's just pretend that home prices stay flat. I don't know what world that would be, but let's just say we see zero appreciation. And so a $600,000 home is $600,000 this time next year, right? The exact same home. Well, let's also do this. Let's say that interest rates come down. All right, cool. So we just said that we're not going to see any appreciation. Home prices are going to stay flat. The economy is awful, right? Whatever the narrative that this one wants to tell right now. So same home prices this time next year, and we're also going to see interest rates come down. All right, so let's say that interest rates come down to 5.5%. So now we have 5.5% interest rates. The home price that was $600,000 today is $600,000 next year. Well, what happens? Historically speaking, what happens is if we do see the cost of money go down and we do have more affordability, we actually see more people raise their hand to purchase houses. So what you're going to see at that point is you could actually start to see bidding wars. You could actually see more people raise their hand for the same home. And then what happens is it gets a little bit weird, right? And if anyone that was in real estate back in 2021 and the beginning parts of 2022, we lived through this to where we had these people where we had limited inventory. We had interest rates that were at all-time lows. And when we're going through, what they did was they had to bring money out of pocket. They were doing these things called appraisal gap coverage. And for anyone that lived through appraisal gap coverage, that means now you really are house poor. You have gone through and you were saying that, hey, I really want this house. You have it listed for $600,000. There's 5 other offers. We would be willing to pay $50,000 over. Well, if the appraiser doesn't believe that the value is there, then what happens is the buyer has to come with that money out of pocket. They can't get a loan for that. So now they're going into their savings. They're going to their 401ks. They're doing early withdrawals. They're doing something to tap some kind of money to get the additional $50,000 because they cannot tie it into the mortgage. And what they're doing is, I actually had a house that I showed a buyer last week, and actually in the confidential remarks, it said that we expect proof of funds as well as appraisal gap coverage. And so I don't know if that's a real market that we're in right now. Obviously, this agent believed it for that home, or this is just something they've been doing since 2021. But they're actually saying, hey, if you're going to offer more for this house, we expect you to pay it. We're not going to take any offers that actually you're not bringing any money to the table. Then here's just another slide when we're talking about appreciation. These are actually the factors that they're going through, and they're saying this is what accounted for what we've been seeing, right? So we're going through and we're seeing, back in 59, we have the Eisenhower recession. Feds raised rates. Cool. So we saw it come down. We see oil prices came down. We see Fed raises rates all-time high back in 82, and we had a recession. Prices came down. Savings and loan crisis came down. Great recession, housing crisis, prices came down. And then the Fed raising rates in May of 23, we saw prices come down. So we can actually see that a lot of this is driven to the cost of money and or banking prices, right? Like that's where we're seeing home prices actually coming down. So when we're having these conversations, with potential buyers. And we're talking about, historically speaking, home prices go up year over year 4% since the 1990s. Also, the only real time that we've seen since the 1990s, from 2006 to 2011, on average, prices went down 4.4%. But every other year, home prices have gone up. Also, when we do see these home prices actually come down for any reason, it's actually around a banking crisis and the cost of money. Well, guess what? We just lived through the cost of money being high, right? The last 2 years, cost of money has been high and rates are coming down. We'll look at that here in a second. Then when we're going through and we're looking at what actually raises prices, inflation or appreciation going up, right? Like we can actually see that most normal markets, we're actually seeing this appreciation, and we can actually see a lot of these tips where it actually raises really high, but yet we can't go through and time either one of these. I think that's the biggest mistake that a lot of people make, is they're waiting on the sideline. And when we're looking at the interest rates, I think this is what actually scared a lot of people, right? When we're looking at the interest rates over the last 2 years and would just ebb and flow back and forth, back and forth. That's when people were trying to time the market, time the cost of money. Well, what's pretty cool is we'll look at it here, but we're actually seeing really, really flat interest rates. The cost of money staying flat. And I'm telling you right now that we're actually going to see more and more people raise their hand looking to purchase a house, because they can actually almost predict what prices are going to, or what the cost of money is going to look in 30 days, 60 days, 90 days. Any questions on this before we move forward? I know that was only 3 slides. We'll go through more of this at family reunion, or not family reunion, team rally after next in March. Cool. I did see this. This was kind of fun. This is in Salida. We'll go through it real quick, but this is what 6.9 gets you in Colorado. In Salida, you can have your very own castle. And so here it is, Gothic style castle. I think that one of you should either find the client or buy it yourself and invite all of us to come look at it, because I think it is very, very neat. But this is what 6.9 gets you right now. Gets you this entire castle. But let's move forward. So that's Salida, Colorado. That is a 3120 Bear Dens Drive.
Sedalia.
Sedalia. Yep, not Salida. Yep, Sedalia. And so we're looking at 5-bed, 8-bath, 8,100 square feet on 15 acres. When I was looking for it, I actually just saw it somewhere and I thought it was Salida at first. And I typed in Salida. I'm like, this isn't anywhere. So then I had to redo my search. I appreciate that. Here we go. Among the nation's 200 largest housing markets, we are one of the lucky 41 that is pre-pandemic highs. And so if we're looking at this, right, we're going 2018, 2019, pandemic hits in 2020. Remember, anything pre-2020, when we're talking about 2019, this is what we consider a normal, healthy market. So as we're scrolling through the list, Colorado Springs pops up number 1. There is 39% more inventory in Colorado Springs today than there was in January 2019. We go down a little bit further. This number isn't as impressive. Like, this is when we talk about like numbers lie and numbers tell a story, right? We're talking like 23% higher. And we're really just looking at 754 versus 612. But anyways, Boulder, right? Boulder's on the list for next Colorado. And then we get down to the Denver, Aurora, Centennial. So we're looking at this 19%. We're at 64, almost 6,500 versus 5,400. So we have Greeley, 12%. Again, this is a small number. We're going 969 versus 863. And we're looking at this, and this is what we're talking about when we're talking about interest rates being where they are right now. And I'm not a, marry the house and date the rate person. I think that's actually very, very dangerous advice. But yet what we do know is this. We know that there are people out there that have motivating life events that are happening and they need to buy and they need to sell. It doesn't matter what interest rates are doing. It doesn't matter who the president is. It doesn't matter what is going on in the world with an asterisk beside it, because I guess there could be some craziness going on in the world where probably no one's moving. And yet, when we're talking about these different things, we know that there's more inventory on the market. Some of this inventory has been sitting on the market for months. And if we're having conversations with our clients, we're being that real estate economist of choice, and we know that there are motivated sellers. There are people that are putting their home on the market because they need to sell. There's something that is making them move. There's also motivated buyers. And I think what's cool, and we all got to keep in mind what's happening with contracts, right? In these contracts, we actually have probably the best time we've ever had to negotiate a contract as a buyer's agent today. We have the ability where we're going through and we are negotiating concessions, right? We're going through and sellers are actually more apt to come to the table and to actually give a little bit more to the buyers to actually get these homes sold. And so when we're looking at all this competition, right? Because this is competition. When I look at this, this says that there is more homes probably on the same street and or neighborhood or in the general vicinity that looks like the house that's down the street. And can we come together and put together a deal to where it's a win-win for our buyers? And what's interesting, what's neat about all this, right, is that we can actually go through, we can do buy downs. We can do different things to get the home price down. And so this is where it's very important to be making sure that we're having conversations with our lending partners to where we're going through and that they are letting us know kind of what some of the loan products that they have. Even some of these new builds. I was at a new build, one of those geo homes, right off of Indiana. And they had, I think it was a 2-1 buy down that was still going on. And it dropped the rates down to like 4%. And for VA, I think it got down to 3. And so when we know these different things that are going on, like that actually saves our clients a lot of money. So are we going through, do we know what's happening with the rates to where we're able to go through and say, hey, look, there's more inventory on the market. We're able to negotiate some concessions, right? Land Title was going through and saying how many concessions that they were actually seeing on a contract. And we're going in there and we're negotiating the best deal for our clients before we even get to any of the other contingencies, because this doesn't even include what's going to happen during inspection, during appraisal, during anything else. This is a great time, I think, to actually be a buyer where you're in more control. Yes, interest rates are still a little bit elevated, not as elevated as they were in 23 and in 24. And yet, there's so much more competition for sellers right now that they actually are willing to drop some of these prices. So, congratulations. Out of 41 markets, we own a couple of them uh, for pre-pandemic inventory highs. But let's go through. Let's look at Logan Moshami, and he says, "Can the government job cuts lead to lower mortgage rates for the spring?" And here's the thing: probably, right? Like at the end of the day, probably. When we're going through, and I feel like it's been a conversation a few times, at least in our market center, where we've gone through and we've talked about these federal buildings and these employees that we have in Colorado. And we do know that this is a pretty big job sector where I think right, wrong, or indifferent. Over the weekend there was an email sent that said, "Hey, throw your top 5 things that you accomplished last week, and if not, don't bother coming to work." And this is the stance that they're taking. And what's interesting, right, especially with this stance, is that it was like, is anybody even opening their email? Like, I think that was even just the real point, right? Like, are people, are government employees even opening their emails? Are government employees actually going to work? And what happens if we start cutting a lot of these government employees? Well, that's a big job sector that starts to go away. Well, what happens when we actually see less people with jobs? Historically speaking, we actually see interest rates go down. All right. So more people with less jobs, we actually start seeing interest rates go down because they got to stimulate the economy somehow. right? Because less people have more money now. Less people have more money. And so what they do is they try to get people to spend money. And how they get that is they go through and they lower the cost of money. So it says through it says could the job loss of the government sector be withdrawal of the funding from the economy significantly increase the unemployment rate and a surge in jobless claims? And it says it's intriguing thought, especially considering how this aligns with the White House officials' strategy to boost labor supply, reduce aggregate demand, and potentially drive down the 10-year yield. So as we're going through, we're not going to talk about the 10-year yield. We're not going to talk about mortgage spreads, but purchase application data. Let me hit refresh because for some reason, there it is. Cool. Guys, as we're looking at this thing, we're a little bit higher than 2024, which is a good thing. And we're right in line with 2023. So these are your consumers. Interest rates, guys, interest rates are looking more and more favorable. I'm actually excited what interest rates are doing right now. Also, there's more inventory on the market. Do you know if this is one of the people that are in your ecosystem? And are they making a move without you? Because what's also interesting, if we go all the way here and we jump into these slides again and we look at, I think it's right here. So this is the first step. They actually go through and they look at homes online. 43% start their system online. But then, like, as we're going through a little bit further, how buyers found their agent, it was referred to a friend, family, neighbor, cool. And 75% of real estate agents did business after meeting with a client. That's what this tells me. We can look at it as only 75% of all buyers went through and they talked to one agent. You just have to be the first agent that somebody is talking to. So when we're looking at this and we're going through and there's more people raising their hand, they're interested in what they can actually qualify for. Our only job is to be right there. We just have to be in emotional proximity to someone when they're thinking about transacting business, and the odds are in your favor. 75% of the people, of the population of buyers, they go through and they use the first agent that talks to them. So when we're going through and we're looking at this and we're seeing that, there's people buying houses, they're talking to lenders. Well, are you positioning yourself to actually be in that conversation? Weekly pending sales. So if we're looking at this thing and we see it, we're a little bit lower than what we were in 2024, and we're a little bit higher than what we were in 2023. So it says 4% less single family housing in contract versus last year. So we are seeing some people raise their hand, right? Versus 2024. Look, so we're actually seeing more people go out and get pre-approved, but there's less people that are in contract right now. So again, this tells me that there's opportunity. We're seeing more people raise their hand, less people are under contract. Guys, there's opportunity out for us to be the first agent that people are talking to. We go through weekly housing inventory. Here we are. Like, this is not a bad thing. We want to see more inventory. 29% more inventory versus last year. Now, again, we know 2019, this is considered a healthy market. Like, we do want to see inventory keep climbing. And here's the reality of things. There's not enough land that can be bought for people to keep, builders to keep buying and building properties. Also, there's not enough resales happening. So I don't truly believe that this line's going to ever really cross here. And this is what we also have to think about. Historically speaking, sellers become buyers. Sellers become buyers. And when we're talking about that, when we have a seller that's becoming a buyer, they're putting a piece of inventory on the board and they're removing a piece of inventory from the board. What's also interesting is when we start to think about generational wealth, right? So we're talking about generational wealth transfer. And I think that is not there. Your generational wealth transfer in the United States. Like I passed it. We're looking for some circles. But when we're talking about the baby boomer generation, and they're talking about how they have the most wealth of any other group in the United States. And we understand this, we know this. But as we're going through, there it is, I think, nope, generational wealth, there it is. Boomers currently control $85 trillion in assets, which is almost 50% of all the assets in the United States. 19 trillion of those assets is in real estate. Okay, cool. So we're talking about $85 trillion boomers, one generation, controls. So when we look at this, so 73% of people over 55 say they want to give all or some of their estate to their children before they die. All right, so we've seen this. We have seen that, some real estate's never actually going to transfer hands. It never will transfer, or it will never transfer to another family. They're going to keep it in the family, especially if it's paid off. If it's paid off and they're really just paying taxes, well, what's the point of actually selling it unless you need some of the funds to go do something else? And it says 30% on average, they want to give away 30% while they're still alive. Okay, so 30% is what they want to give their heirs while they're still alive. So 30% of $85 trillion. Well, this is where it gets interesting, right? When we're going through and we're talking about money being given to, you have your millennials and your Gen Z and whatever else there's out there right now that's of home buying age. Well, then you have to think of these guys. So they get a money infusion from their family. And then what do? Well, they just take inventory off the board. They're not putting any inventory on the board, right? They are a consumer at that point. They are not going through, they don't have a house to sell. They're actually, I would make a joke about avocado toast in a parent's basement, but like in all reality, like that's pretty much what it is, or maybe an apartment. And we will never, ever get to these levels where we're going to see higher inventory than what we did in 2019. So this might raise a little bit more, but it's going to have to get flat at some point. We can't keep building. There's not enough land unless people are wanting to move to Alaska and Wyoming and some of these other places, which no one wants to go to. And we have to keep in mind the buyers, especially the younger generations, are just going to be consumers. So when they do get these cash infusions, they will just be pulling inventory off the board. And so we will just start to see them coming off. Your new listing data, right? We're seeing more new listings hit. Cool. Like we need this. We need to see as many new listings come to the table as possible. But yet, as we're seeing interest rates come down, remain flat, we're actually going to see this number change. We're actually going to see less inventory on the board, especially as we know that we're in a seasonal industry. And when we're in a seasonal industry, we know that we're not in peak season right now. Yes, we have seen some flurries. It's been interesting. We have seen some multiple offers. We have seen some homes go over asking. And yet, historically speaking, we're not in the market yet. Here we are, 33% of all homes in the United States have taken a price cut. Cool. We know that. That's the historical average. And we're there. So here we are right now. We're actually looking at this thing on the map. We're a little bit higher than what we've been year over year. We're way higher than what we were in 2022, but keep in mind, interest rates were still super low right here. And then as interest rates were picking up, we saw more and more price decreases. So what they're looking at for this week, they're saying this week, right? They have a few Fed presidents speaking, and they're going through, which is today, later today, which could provide, like this is interesting day of quotes, right? Because this is what happens when these guys talk and they speak out of line or they speak their mind. What happens is it starts making things happen in the market, right? They actually start seeing stock market sell-offs. They start seeing people actually go out and buy stock. They see all kinds of stuff happening. They're also going to go through this as we have some bond auctions, home price data, durable goods. We will be on job claims alert for the rest of the year. And yes, because of this, government layoffs. We don't want to see anyone lose their job, right? That's super anti-American. Like we're not cheering for people to lose their jobs. Yet we know that we are in an industry that is disproportionately affected when it comes to the cost of money. We deal in a product that has the highest price tag. This is the largest financial decision that most Americans will make in their lifetime, especially here in Colorado when we're talking about $600,000 price tag. Most people don't have that money in the bank, so they have to go borrow money. And with the cost of money being where it is right now, that's why we have seen a slowdown. Well, we know that one of the biggest levers that's out there, it's no longer inflation. The inflation outside of eggs, which you can never go get at Costco or Sam's Club anymore for whatever ridiculous reason, is when they're going through and we are talking about jobless claims. So jobless claims is the biggest lever that's going to be being pulled right now. So this is going to be the interesting one. This is the only news that you're seeing right now is government layoffs, Elon, government layoffs, Elon, government layoffs, right? Like, so as we're seeing this, if these numbers start going up, which guys, here we are right now, like there's nothing really happening of all the stuff that's going through. And we're talking about these guys taking their pensions or they're taking their payoffs and everything that's happening. We haven't seen this number go off. We don't necessarily want to either. And what I do know is this, if it does happen, there's going to be more people raising their hands to go buy houses. And you guys just need to be in the front of all this that's going on. So this week, the Federal Reserve's main inflation report, the PCE, will also be released. And so this inflation report has been adjusted to show slightly lower inflation levels than people were concerned about earlier this month. Because we're seeing inflation go down. I mean, that's just what it is. We are, outside of eggs, because there's no chickens. So somehow you can still go buy chickens, but you can't buy eggs. It's weird. But here's your interest. So here's your rates right now. And guys, here's 1 month. Like this is flat. Let's look at 3 months. I don't really want this December data, so let's actually change this. Let's just go January. So let's go first of the year to yesterday. Guys, this is what we want to see. This is absolutely what we want to see. This gives people hope. It is going down a little bit, right? Like we're seeing it go down. We're not living on the roller coaster that was 2024 and 2023. We're going through, and keep in mind the biggest thing, if I sell my house today, what can I afford? So when we're seeing interest rates going down, we're seeing them stay a little bit flat. That gives people hope. Because when we're looking at this thing, let's look at Altos data. And yes, if you've been paying attention, they did change their colors. But if we're looking at this thing, here's just 8 triple lot 2. Median home price. Okay, cool. We're going down. 624,000. More homes on the market, which means that there is more competition, which means if you are a motivated seller, you can't have the second most expensive product if you're talking like for like. You have to be at or less than your competition. This is good for buyers. We're going through median price of new listings, $499. Price per square foot, like we're seeing all these things go down. We're also seeing average days on market go down. Okay, cool. Prices are going down and homes are coming off the board quicker, as well as interest rates are going down. Guys, we're seeing a correlation here. We're seeing this happen in real time. We need to go out and have more conversations. We also looked at mortgage applications, right? We're seeing mortgage applications be a little bit higher than what they were last year. So we're seeing mortgage applications pop up. We're seeing interest rates go down. We're seeing prices go down. We are seeing less days on market. Guys, we need to be having as many conversations as possible. Like something is going on. And guess what? We're not in the buying season yet, but it's starting. We go through your average days on market. So this has come down, at least in Arvada, right? We were talking at one point, 163 days. We're sitting at 118 right now. That's a astronomical drop. Median days on market, 28 days. So then we're going through and we're talking about this median list price of 624, which has gone down. And we're seeing the median days on market, which has also go down to 28. So now we're going through and we have a home that's priced right and it's lasting a month on the market. So when we're talking to our sellers, these are the conversations that we need to have. If we price the home right, and guess what? Pricing it right means that if you have a home that's like the neighbors, even though no one thinks their home is in worse condition than their neighbors, If we price it right, then we're actually going to be off the market way quicker. So what's the motivation? Mr. and Mrs. Seller, why did you contact me today? How quickly are you looking to get your home sold? What's important about that to you? Where are you moving? Right? We need to be having all these conversations so that we can actually help them navigate this largest financial decision that most Americans make in their lifetime. We're going through, here's your price cut decrease. So we just looked at the national average, 33%. Here we are in 8 triple lot 2, 42%. 42%. We had a lot of overpriced homes, but now we're seeing home prices come down and they're moving quicker. Guys, this, I mean, like people aren't living in 2021 anymore, right? Like they're actually putting realistic prices on their homes. We're going through price increases. Number doesn't excite me. This is phase 2, phase 3, phase 4 of new builds, right? This is all they're doing. They're going through and they have the home that is the model home that they put on the MLS, and they're raising the price every time they get to a new phase. Like this is happening. Relisted 11. Yep. Yes. Go ahead.
Can I ask you probably a very basic question? On the, it says it's a strong seller's market. And when I look at that visual, where is the line that says buyers versus sellers? Is it the white block there? And how is it getting to strong seller's market versus, I would think that'd be way far to the right, but maybe I'm looking at this thing back.
Yeah, so when you're looking at this, your white's going to be your balanced market, this little block, and then this is going to be
Okay.
your buyer's market. So they're actually going through, and it's kind of interesting. They have their own way of that they're indexing it. And so when they're going through, there's going to be pieces of months of inventory. That's how, like, that's the old school way of doing it, right? Where we're talking about
Right.
1 to 3 months, 4 to 6, 6+. And so that's where they're looking at a lot of this data is like how many months of inventory do we have? And so they're saying that like, hey, if we were to go through and we were to not put another home on the market within 1 to 3 months, every home would be gone.
Okay.
And that's kind of what they're talking about. So that's how they really do a lot of this. Now, what's interesting is when we talk about like that being the gold standard of are we in a buyer's market or a seller's, there's still pockets. It's weird. Like I would say that there are pockets, especially because we're just diving into just a triple lot 2, right? But when we're going through and we're looking at a lot of these different pieces, um, we can see neighborhoods that are in buyers markets right now. We can see neighborhoods that are in sellers market. Again, like I was showing property last week and we were talking multiple offer situations. So the right home still sells. And we saw one, I don't know if, I think I talked about this a couple weeks back. There was one where they did a Black Saturday sale, right? Like they actually went through and it was half off of a home in Golden. Firstly, it was a modular home, which was interesting. But secondly, they had this $900,000 home that they listed for 3 days, and then they dropped it to 450K. And then I think it went to like 965 or something was what the home went for. And so we're seeing all kinds of interesting stuff, but that most of this is going to be driven off of if we were to not put another home on the market, how long would it take for every home to be gone?
Got it.
Your inventory, they're just ranking at 19. $3,000 is your median rent. And then they're just their market action score of 46, which is saying it's just a little bit less of a seller's market than it was last month, because last month they gave it, I think, a 50. So as we're looking through, again, I think the biggest things that we need to take away is there's more inventory in Colorado. Interest rates are going down. There are people raising their hand talking to lenders. Do we know who they are? Are they our clients? And how are we helping them navigate this? What are we doing? We got to be either prospecting or marketing. Like those are the only 2 ways that we're going to get in front of people. And so we got to decide like how we want to play so that we just have our unfair share of every home that happens to sell this year. And we could be a part of that.